How about now, Billy?
Yeah, I had to hit start.
Oh, you started?
Yeah, well, I can thank you everyone who is here live with us for today's webinar. We will be talking and covering many things around self-directed IRAs. Even if you have a self-directed IRA already, there will be, I think, some things that will be very beneficial for you to explore and to hear later today. I do want you to know that we are open for questions. If you have them, as you think of them, go ahead and type them into the chat. Charlie and I will hit as many of those as we can and save them for the end and try to address as many as we can today. There will be a webinar link that we will send out and get everyone to, get it to you later. So if you have to jump and you don't have time right now or you're in transition, no worries. We'll send out a full link of the webinar later. Few disclaimers here. If we do, I do want to show some charts and things. So if you are looking at past performance, it is not any indicator of future results. Pretty standard disclaimer information here. We're not making any promises about performance. You always have to do your own due diligence and your own research. Talk to your tax attorneys, talk to your financial advisors, your CPAs. You definitely want to be aware of everything you invest in and do your own research so that you are well equipped to invest wisely. We'll be talking about our high yield fund 2 a bit today and other offerings. So again, happy to answer any questions you may have and things like that, but let's go ahead and jump in here. So when it comes to self-directed IRAs, and I'm going to be jumping around a lot here, so I apologize if the screens just keep going. But when it comes to your self-directed IRAs, even if you know what that means and you have one already, I'd like to talk to a little bit about how to go about that route and why they exist. If you are in traditional finance, or let's say you saved for a 401k plan, and in your company you've rolled that over into an IRA, which is your individual retirement account, it can only be in your name. And people are pretty familiar with that, familiar with how you can invest that. You will typically have allocations and investment opportunities in stocks and bonds, mutual funds, ETFs, all the things that a financial advisor would do for you. I've been a financial advisor. I was in that business. I had my own registered investment advisory firm for a little over 12 years. Co-founded the firm, very much enjoyed asset allocation and investing in the markets. I could talk all day long about it. If any of you have any questions at all, please feel free to reach out. I am no longer licensed and registered. I sold my firm. I sold it and am fully engaged now on the alternative asset space, which is where you invest self-directed IRAs, and which is why I'm with Secured Investment Corp. I love this area. I love the real estate offerings that we have, and offering something besides what you would normally see in traditional finance, like the typical stocks and bonds and mutual funds and ETFs. So all that being said, they exist because there are laws around what you can invest in and what you cannot. And when you have an IRA or 401k and you are in that plan, you can invest in traditional items. In a self-directed IRA, it opens you up to many more things. And I'm going to jump out of here real quick and show you what some of those opportunities look like. This is a self-directed custodian that we work with quite a bit. I'm going to show you a list later. We work with dozens of self-directed IRA custodians that hold your IRAs. But when you go into investment types, the options become available that are outside of traditional finance, that are outside of what you could invest in, say, in the stock market. So here there's real estate, there's private lending, private equity, foreign exchange trading, if you want to change currencies, of course, mutual funds and stocks, precious metals, cryptocurrencies, just all kinds of investment types and things to consider outside of traditional investment methods. Now, why I listened to an educational webinar one time, I think it was Advanta IRA, and they were saying that as little as 4% of the investable money that's out there in IRAs, only 4% of it is in self-directed IRAs. Now, why is that? Why is it such a low kind of response rate, or people that want a hands-on investing? Why is that the case? I have a couple of theories. One is it takes time and some focus. You know, you have to educate yourself. Self-directed means exactly that. You are choosing what to invest in. You're not always necessarily relying on an advisor, relying on a professional person, right? If you want to explore these things and how to invest in cryptocurrency or precious metals or private equity, you have to make that decision and that choice. And that's all well and good. And I think more and more people are getting there. More people are realizing they don't love the volatility that a typical index fund or the whims of the market. 2022 being the worst bond market in history. It was the fastest rates have ever risen by the Fed. And when rates rise, bond prices, bond principal goes down. And people realized 18, 20% losses on their bond holdings. That's highly volatile. Anyone who loves losing 20%, raise your hand. I don't think that that kind of volatility, people will put up with it for very long, right? And we all know the stock market will do it. We all know the stock market will pull back 30, 40, 50% historically. And that kind of volatility eats away at your return. It eats away at your investment, time horizon. And most advisors, having been one, there are some things that I love about the industry, and there's some things that I don't like where it's headed. And one is I feel like the whole industry of financial advice is getting commoditized. It's getting to where they just punch a button, they put you in a model portfolio, and you get invested in these things, sort of just kind of going along with the ride. You're just doing what the market does. And I've never been a big proponent of that, because what they will show you typically over time is a 70-year time horizon. So if you're in the market all this time, you ride out the whims, then good on you. You will come out ahead, because you will stand for the long term. Well, not everybody has a 70-year time horizon. Some people need to get money out. Some people want that principal protected. And what we're learning more and more is that people want to be able to live off of passive income. They want that money working for them in a way that's paying them, monthly, quarterly, annually, getting those returns out of the market and never touching your principal. That's a sweet spot that we all really, really want to be in and want to be living. So I wanted to show you, from the very start, you start in traditional ways of saving in your 401k, or maybe you roll it over into an IRA, and then you have these options and other alternative investments available to you in self-directed IRAs. Now, many of these investment choices don't necessarily always offer you the passive income that you may be seeking. Take gold, for instance. Gold is a very good safe haven. It's a very good defensive play. But most of us don't walk around and really hold gold bars. Although I think at Costco you can actually buy gold bars now, but they sell out as soon as they get them. But even if you hold those gold bars, they don't pay you dividends. They're not paying you monthly. They're not paying your electricity bill. They're not paying you a dividend to hold gold. It's a very defensive play. Not saying I don't say you should own gold. I know a lot of people that do, and it does very well in inflationary times. There's reasons right now that gold is hitting higher and higher prices, right? All the precious metals, gold and silver. There's a reason for that. They keep up with inflation kind of because they have to, and because people go and invest in it when times get inflationary. Prices are getting higher. So as an investment asset, it makes sense. Like we're all good with that, but it doesn't pay you a dividend. It doesn't create passive income streams. Cryptocurrencies, different things. I mean, if you really want to build passive income streams and passive wealth with protection of principal, many times you will go back to real estate. And real estate, by and large, over time, has done extremely well. And of course, we're a big proponent of it. It's what we do at Secured Investment Corp. And I just wanted to show you one of the things that we do is we have a fund that is for accredited investors, and we manage professionally a portion of this fund. We will manage about 25% of the fund ourselves, and we will manage those in assets and real estate assets that will pay you to hold them. And we have double-digit returns. We basically have a couple of ways you can invest with us with your self-directed IRA. You can invest in a fund and we have a few of them, or you can buy a note. And buying a note is where you're the banker with the money and you can earn double-digit returns. We're running a special right now in May. I mean, we're talking 12, 13, 14% returns. To earn those type of returns in the market typically takes a high amount of risk, a lot of time, and you're not guaranteed your principal. And here, at least your principal is backed by a real physical asset, and that asset is like gold. I mean, that asset is paying you a dividend to hold it. It's paying you 11, 12, 13, 14%. So we love real estate. We love the funds that we have because you're partnering with us. You're getting professional management along with your investment. There's a portion of it that we manage ourselves. We're doing the same things with the money, and you just become a partner with us. We do this nationally. We in the Pacific Northwest will manage our own properties. We will lend out nationally to other people doing the same that we have educated, showed them how to do it, how to make money in real estate, be successful at it themselves, and actually create passive income streams. So when you're buying a note or you're investing in our fund, you are holding a real, it's really backed by a physical real estate asset, and then you are collecting dividend checks monthly or quarterly. Great way to build wealth. And here's what that looks like. Over time, this is an example of $100,000 invested with us 10 years ago. And had you stayed in our fund two, with a preferred rate of 9%, we've done better than that, more like a compound annual growth rate, if you let your dividends stay in there, have accumulated more like 11% a year, over 11%. So we reduce the volatility. We're taking away those large drawdowns and that rough ride to get to where you want to be, and it's all backed by real estate. It's all backed by an asset, and we're very, very big fans of how that looks in your self-directed IRA. Now, here's an example I want us to spend just a couple minutes on. These are widely held real estate ETFs that are out there right now and have probably billions of dollars in them. This is an iShares, IYR Real Estate, Vanguard, Schwab, what is this, Van Eck. So these are very popular ETFs, very widely held. And as we go through these numbers, we all start with the same amount of balance. This is our fund here, our real estate fund here at Secured Investment Corp. And over 10 years, this is a 10-year look back as of this past first quarter, you can see what you would end up with. And again, the reason is because of this rough ride. You look at this worst year column here, and I don't know about you, but I don't love losing 25%, 26%, 27% in any given year. And this is what is available to you in a traditional IRA, 401ks. You're in this place where you have to invest in public funds like these if you want to be in real estate. If you want to invest privately in a self-directed IRA, you find us. You find us who can come up, we can come out there, and our worst year is a positive 8%. I mean, this is a layup when it comes to financial management and asset allocation. It's in large part why I'm not an advisor anymore, is because I want this kind of access and this kind of availability. And I won't tell you this story of just ride it out. I want to tell you the story of protecting your principal and letting your money work for you over time. That is the way to wealth. That is the way to wealth generation and actually living off of passive income. Got to drive that home. That is the way to build wealth and live off passive income. So I think we had someone raise a hand or have a question. Did anyone have anything timely? Charlie, do you see anything there that we need to jump in and hit right now?
There's a question in the Q&A, but Jules Lee has got his hand up. So if you want to unmute him, he can ask his question.
How do I do that?
Just look under participants. Actually, I'll do it.
Okay.
Oh.
Can you do it?
I think he disappeared.
Did I disappear?
No, Jules is gone. So.
Oh, okay. Anyway, okay. So here's what I want to do. Financial advisors, if I can spell. Financial advisors put you into what are called model portfolios. I hope you don't mind. I just kind of want to take some notes so you see it. Model portfolios are an allocation that they create with your IRA, your 401k, your investable assets, and they go punch a button. They say, okay, you should have 30% in equity and 20% in bonds and 10% in real estate and some in international or whatever it may look like. And that's what advisors are trained to do, is put you into a model portfolio, let it ride over time, because those assets are supposed to offset each other over time. Okay, that's the model of what's out there. When you're talking to advisors, that's typically what they go to. The problem I have with that is what I showed you earlier. When things go bad, when you have serious drawdowns of even, like I said, in bonds in 22, the worst bond year ever, of 18% to the downside. Here's real estate, 25% plus to the downside. Equities, 39%, 40%, to the downside. They don't offset each other. Okay, in the long term, your allocation, it actually all correlates to one. They actually all correlate together when it all goes bad. So, when we talk about our worst year ever being a positive 8% versus their worst year ever of being a minus 25%, that's the difference that we offer by putting your money into a self-directed IRA and putting your money, in a place where it can earn passive income. Now, something else I want to show you, or I guess make the point, is the reason financial advisors, some are warming up. I mean, there's definitely some financial advisors in the smart money that goes after more alternatives, private equity. They know this is a way to build wealth. You invest in businesses, you invest in things that are, again, not available in the market, right? So private equity, real estate, this is where the wealth happens. This is where asymmetrical returns happen. And a big reason that advisors don't love this space is because of access. There are barriers for them to invest for you in things like real estate or physical gold or those things. The reason is because they typically can't charge a fee on it. There's not a very clear way for them to charge a fee and have access to these things. So this whole universe of self-directed IRAs exist for a reason. And I'm giving you the reasons. I'm showing you behind the curtain. And having been in that space as a financial advisor for a long time, and now dedicating my life to be living in alternatives and investing, heavily in real estate, this is the place you want to be in inflationary times, which is where we're headed. This is where you want to be in recessionary times, which is where we're headed. And typically we would say, oh yeah, 10 to 20% real estate. I would bump that number up. I would look at your bond holdings and the kind of yield that you're getting there, your real estate holdings, the kind of yield that you're getting there. And I would firmly ask your financial advisor, or come to us directly, and see how you should create your portfolio that will actually give you income with protection of principal. Because if you're willing to lose 20 to 25%, and you're willing to watch your bonds go down, you're willing to watch your real estate go down 20, just don't call me. I don't want to have that conversation with you, because you don't understand what I mean if I'm really saying protection of principal. We protect your principal. It's backed by an asset if it all goes bad. And this is what your income earning stream looks like with us when you're invested in real estate. And we're doing all the work behind the scenes. We're doing all the work behind here to create this passive income stream transactionally. We're vetting people. We're lending money. We're successfully, doing it ourselves. You have professional management behind you, and these are great options. And we're doing it nationally with a very, very strong team. So let me see if there's anything else I want to show you. Oh yeah. So when it comes to setting up a self-directed IRA, if you have not done this, or you're a little bit uncertain about how to go about that, we are here to help. I have a very strong investor relations team at Secured Investment Corp. We work, I got tired of typing and I ran out of room. But basically we work with dozens of self-directed IRA custodians and trust companies in the United States that will allow you to move some of your money over from out of your IRAs or roll over a 401k into into a self-directed IRA, or some people just transfer it. They just transfer maybe an employer plan, their own, if you're self-employed, you can move your SEP IRAs, your simple IRAs. You can move all these things over and invest, in your business this way too. And I'm telling y'all, I've been around it for over 20 years, and this is the time to be heavily weighted into asset back, things that are going to be creating income for you. If you want to hold gold, go for it. It's definitely defensive. It does well, but it's not going to pay you a dividend. And you can't do anything with it. You can't go to Costco and give them a gold bar to go shopping with. So I'm a big believer in the offerings that we have. If you want to talk about the differences between us and different real estate offerings, I'm happy to have that conversation, or anyone on our team is capable of having those conversations as well. And we have a whole back office and sales support team that can help you set up accounts, self-directed IRAs, get that money working for you in a passive wealth building mentality that you think your financial advisor is doing for you, but may not always be on the same page. So with that, Charlie, do we have any questions that we want to hit?
We do have a couple questions. Kenya wants to know, is this for Fund 2 only?
No, great question, Kenya. So we have 3 funds. We have Fund 2, which is for accredited investors. We have Fund 3, which is pretty much for anyone. You can get involved as little as $1,000. So we want people to start building wealth. Fund 3 is designed to get you in the game, passively get in the real estate game. If you don't have, $20, $50, $80,000 to put into a property and fix it and flip it yourself, let us do it. Just be a partner, get your $1,000 in and start building wealth. I don't care if you're in your 20s or teens, even better, start building wealth. And we also even have a Fund 5, which is a fixed 5%, but it'll start looking good again when maybe rates come down. But no, great question, Kenyon. Thank you for asking.
And Billy, just kind of to follow up on Kenya's question, what about notes? Can we invest in notes inside of a self-directed IRA?
Yes, we can invest in notes with your self-directed IRAs or a combination. So let's say you have a cash account. Sorry, I didn't take typing in high school. I should have. A cash account, an IRA. You can combine these. You can combine them with family, and you can buy a note. If you're not familiar what a note is, it's basically where you are the bank. People that cannot. I mean, like you go to a bank and you get your mortgage. The bank is happy with you. They're going to sell off your mortgage to somebody else, right? All they want to do is transactionally keep doing that. The bank doesn't want you to be owning multiple homes. We come in to fill where the banks abandon you. So we come in and we set the rates, and we will work with people doing fix and flips and rehabs and keeping that money in motion and building wealth. You can own a note that we have funded. So you're owning something that we have funded ourselves, and you become a partner with us. If you're an accredited investor, you can you can own a fraction of a note. A lot of details there. We could be happy to talk about. We have a lot of note webinars, a lot of ways to get involved in notes. Double-digit returns, very nice. Call it 11 to 14% type of returns in here, backed by an asset, backed by real assets. Protection of principal. These are very key points. I want everyone I'm really drilling these points because these are the differentiators. When you buy stock and you buy something out there in the market, you're backed by the paper that it's written on. And if it goes to zero, you're out of money. Just ask all the people who owned Enron or WorldCom or all these companies that have blown up in the past that looked like they were, indestructible. They were very, very strong companies. S&P 500. In those indexes, they tell you to hold, and some of them are fraudulent. So you want to be in things that are backed by real assets, real protection of principal, and real ways to earn dividends and generate wealth and passive income. Anything else, Charlie?
That was great. We do have a question from Aaron. Aaron would like to know, how do I convert my employer's 401k into a self-directed IRA to invest with us? And is it possible to do it by himself, or does he need authorization or consent from the employer or the custodian? I imagine he could ask that as well. And can they say no?
Yeah, good, great, really great questions. So if you're in a 401k, it's a little bit more difficult. If you don't have your own company 401k, like a solo 401k or self-funded 401k in some way. If it's an employer 401k, there has to be what's called a qualifying event. This is typically things like death, divorce, termination of employment. So if your money is in motion in any way because of things like this, there could be a qualifying event that will allow you to do that. If you are just working for your employer and you're there, it's typically difficult to move unless you're able to move it. I would, there are a couple of ways. There's something called a self-directed brokerage type of component that some policies and some administrators will have. It depends. They don't like to see that money leave. So there's a lot of barriers. It may be worth asking. This is the question you want to ask. Am I able to invest outside of my 401k plan? I would ask your plan administrator. Typically, your plan administrator is going to be someone like, let's see, Empower is really the ones behind it. But the largest players are like Fidelity, Principal, what are they called? Principal Financial, I think. Anyway, you're gonna, Vanguard, you're gonna have very familiar household names. But anyway, they're the ones that typically administer these kind of funds, these kind of plans, and they have their policies. So it may be difficult sometimes to get your 401k in motion or out of there. There is an option where you, as a 401k holder, can borrow against it. And if you want to borrow and invest, you want to make sure that if you borrow at, let's say, and you kind of borrow from your own plan, but you could borrow against your own plan, let's say, I don't know, 4%, I don't know what it is now. And then you go put that money to work with us, let's say buy a very nice paying note at 12%. Well, you're arbitraging your own money. I mean, now you're basically taking money to make money. And yes, that money could be making money at its 401k, but again, you're kind of in the whims of the market. If you love 20+% drawdowns, go for it. But I would rather put something, steady in here and protect my principal and put that money to work, earning something like, 12% or whatever you're comfortable with, 9, 10, 12, 14. But that's a very, very good way to go about it. Again, you have any of these questions, you want me to get on the phone and talk to your administrator, I'd be happy to do that. Talk to these people all the time. Usually they just kind of push paper around, but I'd be happy to go through the policy, ask the right questions, and see how to get that money working for you in a better way.
Great follow up there. We have a few more questions coming in, Billy.
Okay.
What is one of them is a percentage of return on the funds, specifically Fund 2 and Fund 3?
Great question. So we have a 9% pref rate. Pref rate is not guaranteed, but it's like a hurdle rate. It's kind of like what we're shooting for. We're shooting for a 9% pref rate on Fund 2. Fund 3, the pref rate is 6%, which, by the way, these all used to sound really good when rates were at like 0, right? Fund 5 is a fixed 5. However, these are preferred rates. And again, like our Q1 of 2024, our annualized, we were on pace for 10.01%. So if we do what we're doing in the first quarter, the rest of the year, you're going to earn double digits and be over 10% in fund 2. Now, anything above 9, we do split. There is a split. It's kind of an incentive fee for us to do better, right? So anything above 9, we do split with you. But basically, if you stayed in here the entire 10 years, 10 plus years, your compound annual growth rate in this fund is 11.06% in fund 2. In fund 3, the pref rate is 6%. It has consistently been returning more like 7s and 8s, which is fantastic. Again, if you're starting with as little as $1,000 and you're willing to get high returns, people working this hard for you, great way to get started. But anyway, that's typically 7s to 8s. I think our Q1 in 24 was 7.22%. So again, we split anything over 6 with you. I'm gonna call, sorry. And was that it, Charlie? Did we answer all the questions on that?
We do have a few more. This
Fund
next
5 is
one,
fixed.
this next one I really like. Asking about the advantage over stocks and ETFs, mutual funds compared to alternative investments.
Advantage of, I call them public funds. What are the advantage of the funds over private investments?
I think that's what it is, over alternative investments compared to stocks, ETFs, mutual funds like that.
Well, I'll look at it both ways. So let's go back to this. The benefits are that they are readily available and they are easy to get to. So your advisor or yourself, if you have your own account, they're very liquid. They're trading all the time. You can see the posted prices every day. They're just available. I mean, you go to a shelf in Walmart and there they are, right? It's just easy to get to. Private equity, private funds, alternatives take more work. They just take more hands-on work, to become available. We're not out there publicly. We're not traded on an exchange where you just type in, a stock symbol and go buy us. There is guidance, which is why we have a whole back office and support team to do this for you. And but again, you have more control. You have more opportunity to earn, higher returns, and again, backed by physical assets and real estate. But I want to make sure I answered your question completely. So, benefits of a public fund, that they're available, they're liquid. Maybe there's some comfort in owning what everybody else does, but the wealthy people tend to go towards private equity, PE, alt. And I'll type in here, you can look this up, but asymmetrical returns. You're not going to get asymmetrical returns doing what everybody else does. And that's just the truth. So you have to do something, wiser. You have to go find it out yourself. You have to dig a little bit. It's why people have invested in their companies and their businesses. But anyway, ours is the, safest, backed by real estate, one of the safest, best ways to build wealth. This, to me, with risking 25, and I just picked these, I just picked, there's many more. I didn't even go to, mutual funds. These are all ETFs. We can go to mutual funds, you'll see the same picture. But this does not feel safe to me, right? Like having that kind of exposure, that it's available, but you have this kind of exposure to the downside. One more thing I want to show on this chart, I kind of skipped over. This very last line here, correlation to the stock market. Correlation means, am I doing what everybody else is doing? If everyone's on they call it the crowded train. We used to call it on the trading desk, we call it the crowded train theory. If everyone's investing in NVIDIA and the stock's just going to the moon and everyone, I'm making so much money in NVIDIA, and then, it rolls over and loses 30, 40, 50%. That's a crowded train. You're kind of just doing what everybody else does. Well, these real estate ETFs, even though they're in real estate and they're not supposed to be necessarily doing what tech stocks should be doing, they are. They're 78, 73, on anything close to 1 means you're perfectly correlated. If it's 1-to-1, you're perfectly correlated with the stock market. So these are the 70s. We are a negative 0.05, a beautiful number. Maybe one of the only times you'll see a beautiful negative number. We are not correlated to the stock market at all. So if the stock market's losing 30, 40%, we're not going to be there. If the stock market's up 30, 40%, we're not going to be there. We're going to be doing what we do, which is generating very solid passive income, because we don't want that crazy ride. We don't want the crazy upside. We don't want the crazy getting caught in the crazy downside. So this correlation number here is very, very important. We're not going to do what the stock market does. These real estate companies, you can look at REITs, you can look at other mutual funds. They are doing what the stock market's doing, kind of rising and falling with the tide, right? Like they're following along with what other tech stocks may be doing.
Thank
More
you, Billy.
questions? Great questions.
Yeah, we have another good question from John. He wants to know if he can have the self-directed IRA in his own name, or does he need to use a trust or an LLC? And then also, can it be a Roth? Is another follow-up question from him. And then he also asked, do you have a vault? So not sure what that is.
Yeah, we can ask for a little clarification. I'll give my opinion on that. But yes, yes, and yes, basically on all those, you can. Number one, an IRA has to be in your individual name, right? It's an individual retirement account. So individual, yes. Roth, yes. Company plan, like if it's your own company, yes. And what was the other one? 401ks, Roths, trusts, yes. LLCs, yes. You're in the world. I mean, everything you're mentioning right there is our world of alternative investing, self-directed, plans and ways to invest in us. Yes, yes, yes. All that is the best way to do it, quite frankly. If you're in Roths, IRAs, company 401k plans, things like that, you're obviously in a tax deferred world, which is a huge tax savings, right? Just deferring all those capital gains. If you're over here in the trust and LLCs, you are going to be paying taxes just as you would anything else that you invested in, as an LLC trust. You're running through all those expenses through those entities.
Thank you for that, Billy. We've got another one. This one is kind of speaking a little bit to divestment, and the user wants to know, what is the ownership guarantee if they need their money back or something were to happen with the company? How does that work? How do people get their money back once they invest into like the funds, for example?
Great question. And I remembered we need to hit this vault, but let's go up here. I think I have these details on all of our funds. Oh, actually, not on Fund 5. Fund 5 is a 90-day kind of holding period, but our funds have a 12-month commitment. So if you're investing in our fund, it's a 12-month, lockup or tie-up period. I love it. That's again, kind of a sweet spot in the industry. If you're looking at multifamily, self-storage, things that take a lot of ramp up time to build, land and permits and, all these things that have to be built up on a very large scale, commercial, their holding periods are like 4 to 7 years. We have a 12-month commitment, and I think that's a very, very low number, but it allows us to keep stability in the fund. And then on the exit, the divestment you were talking about is typically over 12 months also. What we shoot for is 25% a quarter of returning your capital. So if you're going to invest with us, looking at kind of a 2-year commitment, it'd be a year of you're going to be in the fund, and then sort of a year to get 100% of your money out, which again, I think is a very, very good sweet spot in the industry, especially if you want to start comparing it to those larger projects. I do want to go back, Charlie. So you asked about the vault. If you need a vault, if you're talking about vault of our documents, subscription agreements, fund documents like this that I'm showing you, we have one-pagers and fund documents that show all this, in more detail. We don't have a vault necessarily. We're like a client portal where you can log in, but I'd be happy to send that to you directly if you want to provide an email, just reach out to us. We can get all that to you.
All right, and then we have one person asking about the minimum for a real estate investment. They are building their Roth IRA, and what does it take to get into one of our funds?
What's that now? Building the Roth IRA?
Yes,
And what was the question?
they want to know what's the minimum investment amounts for investing in
Oh,
the funds.
so back up here, minimum for Fund 2 is $1,000. Oh, I'm sorry, Fund 3. I misspeak. Minimum for Fund 2. This is for an accredited investor. And that's a minimum of 50,000. That's typically more, like more of an institutional type investor or someone who understands, what an accredited investor is. Okay. I mean, actually, if you're making 200,000 as an individual, 300,000 as a joint with your spouse or partner, or you have $1 million in, liquid assets outside of your primary home, which could be LLCs and trusts and IRAs and all these things combined, then you are an accredited investor. But it is a minimum of 50,000 in that fund.
All right, thank you. Well, we've got one more question, and it kind of segues into, if people want to get a hold of one of our team members in the investor relations department, they want to know, how do I sign up for the funds? How do I start off in investing in real estate funds? What do they need to do, Billy?
Perfect. Well, thank you all, number one, for listening to me I ramble. I could talk all day long about this stuff. I love it. I love the alternative space. Get yourself, heavily weighted alternatives. Let's talk about the differences between other investments or other real estate investments or anything. I love talking everything in the alternatives world. So thank you for being here. I really appreciate that. Really great questions. I think we were able to really dig in here. We will be sending out this webinar link, and all this will be available for everyone to have. If you want to reach out to me or my team, please feel free to schedule a call, reach out to us at securedinvestmentcorp.com, self-directed IRA here, or honestly, just call in, find us. We use this QR code. We have a very capable and strong investor relations team. We have hundreds, if not thousands, of investors that we work with. Very large, very well-established company. We will be the ones left standing when it gets to recessionary, inflationary times. We are the place to be heavily weighted in these times, and we look forward to working with you. Thank you so much for listening to me today, and we hope to talk to you soon. We good, Charlie?